Hello and welcome to our conversation on accounting. The focus of this session is to understand the book value per share and impact of the dividend distribution on the book value per share. We know that the book value per share is also called the equity per share. It is also called equity per share. So it is equity divided by number of shares. So book value per share will keep on changing based on the business decisions taken. So therefore, it is important for us to understand the impact of business decisions on the book value per share, with the price of a company to a large extent reflects the book value per share. In order to explain the impact of some business decisions on the book value, let us take an exercise. Some decisions, they convert those decisions into financial statements and then examine the book value per share. So this is an existing company with a capital, retained profit, some loans and corresponding assets available on their balance sheet. Now, during this period, in this current year, the company whose authorized capital is 1 million has decided to issue capital or issue shares under the rights issue and the public issue. They also sold stock and paid some expenses, made some investment. So a combination of business decisions were taken during this period. Now let us take one by one to examine the impact of these decisions on the financial statements. So the company issued right shares, 5,000 right shares at rupees 80 per share. So the face value of the share is 10. Okay, it's given here. The issue price is the issue price of the rights issue. The issue price for the rights issue is 80. The face value is 10. So the premium is 70. Whereas for the public issue, they made simultaneously rights and public issue. The public issue, the share price is 100. So share premium is therefore 90. So 5,000 shares raised through rights and 12,000 shares raised, 12,000 shares issued through public issue. So therefore, the capital will increase to the extent of 10 into the number of shares issued, 12,000, and 12,000 into 10, the capital has to be valued at the face value, and the excess money raised is called the share premium, and the share premium in this case is 90 into 12,000, 90 into 12,000. Okay, the capital will increase by 120 and share premium should be shown separately. Similarly, for rights issue, once again the capital will increase by the number of shares, the number of rights shares, which is 5,000 into the face value, and the premium will increase to the extent will be recorded at 70 into 5,000. So the company issued shares through rights and through public issue. As a result, the capital increased to the extent of 120 for rights and 50 because of the new issue. Similarly, the share premium increase because of the rights issue and the public issue. So let us have a look at it. The capital change is because of the rights issue and the public issue. The corresponding increase in the premium is because the shares have been issued at a price, the issue price is greater than the face value. So that is about the rights issue and public issue. The impact of the issue of shares is, if it is for cash, cash increases and capital increases. And if the price is at a price higher than the face value, then the excess money received has to be shown on the balance sheet as a separate item called share premium. The identity of the share premium should be maintained separately because the use of that has been given very specifically in the Companies Act, which we will see later. Now, the sold stock, so there is a sale here. The company sold stock worth of 20% of the stock sold for 380, and the sales is for cash, so therefore cash increases. And because of the matching principle, there has to be cost of goods sold, and the cost of goods sold is 20% of the stock available. So the stock will reduce to the extent of 104. So sales is an income with a corresponding cash inflow, and because of the matching concept, there has to be cost of goods sold, and the cost of goods sold is a reduction of stock. Is a reduction of stock. Okay, then expenses like rent and salary paid. So rent paid 60,000, salary paid 100,000. Both are expenses for the period, and both have been paid during the period. So there is no liability on account of rent. There is no liability on account of salary. Expense paid is an outflow of cash. Expense not paid would have been a liability, but in this case, it has been paid. Purchase X shares. The company purchase X shares. X shares means the company, this is an investment decision. When A Limited issued shares, that is a financing decision which involves cash inflow. But when A Limited purchases shares, that is an investment decision, and that involves outflow of cash. The outflow of cash is 50,000. Outflow of cash 50,000. And purchase of shares is not an expense because this is resulted in acquisition of asset. Share is an asset because it creates an ability for the firm to generate future cash flows. But observe this, X shares, the face value of the share is 10. The market value at which A Limited purchase X is at 50. So that means the X has issued shares of rupees 10 at a premium of 40, or these have been purchased by A Limited from the secondary market at 50. And the only other transaction left is the interest because of accrual principle. You have to show interest and interest on the loan for the entire period, and the period is 1 year. The accounting period is 1 year. And let us assume that we paid interest, and interest is equal to the amount of interest due for the year. So no interest payable as a liability. Expense paid is a outflow of cash. Since all transactions done, we'll find profit. Profit is equal to incomes minus expenses. So income is 380. Expenses is 276. So profit before tax is 104,000. Tax on that is given as 25%. So 25% on the profit is tax. And let us assume that we paid tax immediately because we have sufficient cash, and the profit after tax is 78,000. At present, the company decided not to distribute dividend, so therefore entire profit will be transferred to the balance sheet and no dividend paid. So the retention of entire profit increases the retained profit. Okay, now let us find cash in hand. Cash in hand is equal to cash available minus the cash payments. So cash in hand will be cash available minus the cash payments, which is 1.9 million, and cash in hand is an asset. So two important items on the balance sheet, that is the retained profits and cash, comes from the income statement and cash flow statement. So it is always important to know and remember that the financial statement should be prepared together. No change in the capital in the loan during this period, no change in the creditors in this period. So our balance sheet tallies. So what we have done is converted these transactions into financial statements. Now let us examine the book value per share. The book value per share is equal to the equity of the company divided by the number of shares. Opening equity was 570,000, that is capital plus retained profit plus share premium. Share premium is not there in the beginning. And the closing equity is capital plus retained profit plus share premium. So there is a significant jump in the equity. Equity increased because of the current profit retained and also the issue of shares at premium. So since the equity increased, the book value per share increased from 29 to 61,000. The company did not distribute the current profit, neither distributed the old profit. So the entire profit has been retained. So the book value per share has gone up. So in this example, we saw that the company did not pay any dividend. Now let us understand the let us understand the impact on the book value per share if the company declares dividend, assuming that there is no other change in the financial statements except the distribution of dividend. Let us take the cash dividend. Let us say that all other things remaining same, the company decides to give cash dividend. What is cash dividend? Cash dividend is distribution of dividend in the form of cash. Because the company is having a huge amount of cash on the balance sheet, so therefore company can decide to distribute the dividend. And how much dividend they can give? Because there is a retained profit of 448,000, which includes the current profit of 78. And this is entire is a retained profit, and this belongs to the shareholder. Entire 448,000 can be distributed as dividend. So let us see the situation. So the company has decided to distribute 100%. The cash dividend is 100%, means the conventional interpretation of this 100% is the dividend is always calculated as a percentage of capital. So the capital of the company is 370,000. Capital is 370,000. And 100% of that will be distributed as dividend. So the company has decided to distribute 370,000 as dividend. And the retained profit is was there, isn't it? Retained profit is, we have significant amount of retained profit was there at 448,000. So therefore they can distribute that. So if the company distributes dividend, then it is a cash outflow of 370,000, and the retained profit will reduce to the extent of the dividend distributed. All other things remaining same, the cash dividend leads to the reduction of cash because of the outflow of cash, and leads to the reduction of retained profit because the profit has been distributed among the shareholder. So the retained profit has come down from no dividend 448,000 to 78,000 because of the distribution of dividend. Because the company has distributed dividend, the equity for the company has reduced. Why did the equity reduced? Equity reduced because the retained profit reduced. And retained profit reduced because the cash dividend has been given in this case. And since the equity reduced, the book value per share falls. So book value per share when the company did not give dividend was 61. Observe this, 61. When the company gives cash dividend, the book value per share has come down to 51 because there is a reduction of equity. So whenever a company declares and distributes dividend, there's an outflow of cash, particularly cash dividend, and that leads to reduction in equity, that leads to reduction in book value per share, and all other things remaining constant, the price will also reduce because the asset backup per share falls. That means because the book value per share falls. So price falls because the book value falls. Book value per share falls because equity reduces. Equity reduces because the retained profit reduced, and retained profit reduced because of the distribution of dividend. Okay, so in this case, this is cash dividend. So we saw the impact of cash dividend on the book value. Now suppose the company says, no, I don't want to give cash dividend, but would like to give stock dividend just to maintain the same ratio. Normally the stock dividend is expressed in the form of the number of shares to be given to the existing shareholders. So suppose the company declares stock dividend in the ratio of 1:1. What does that mean? The stock dividend 1:1 means the number of shares at present at the time of distribution of dividend is 37,000, okay, which is 37,000, and then the company gives dividend 1:1, and the stock dividend is 37,000 shares. The face value is 37,000 into 10. So therefore 370,000. Okay. So, so, so in this case, okay, in this case, you see 37,000 because the number of shares is 370,000 divided by the face value. So that is 37,000. And the company distributed another 37,000 shares because of the stock dividend. So stock dividend value is 37,000 into 10. So the amount of dividend to be given is 370,000. Here also 370,000. We see that here also 370,000. But the way the distribution happened in this first case, no dividend. In the second case, cash dividend of 370,000. Third case, the dividend of 370, not in the form of cash, but in the form of shares. So what is the effect of that? The retained profit, of course, reduces because you have distributed dividend to the extent of 370, but not in the form of cash, but the capital increases. The capital increase because of the new shares issued, and this is the stock dividend or bonus shares. So let us see what is the effect of that on the book value. The number of shares have gone up. The number of shares have gone up because you have issued, the company has issued the new shares. Because the number of shares has gone up, no change in the equity. When I say no change in the equity, observe equity, if no dividend is distributed, equity is 2.24 million. But if the stock dividend is given, also the equity is 2.24 million, because all that we are doing here is converting the retained profit into capital. So capital plus retained profit is equity. So the equity is not changing, but the number of shares increases. So therefore, the book value per share falls. So book value per share falls in case of stock dividend because the number of shares have gone up. Book value per share falls in case of cash dividend because the equity has come down. But in both the cases, the book value per share has changed. The change in the book value per share is because of the change in equity or the number of shares. And the market reacts to the change in the book value per share. Therefore, it is always important for us to understand the impact of the business decisions on the book value per share. The managers cannot control the market price directly, but can influence it by feeding information, by signaling their decisions, their intentions, and the book value captures that. Therefore, book value per share, which is also known as equity per share, or which is also known as asset backup per share, is an important accounting number to keep a watch on the impact of business decisions on the on the book value and the market. Okay, thank you very much.